I just finished completely rebuilding my automated trading portfolio. I redid the test, recalculated all the data, and created 10,000 possible scenarios for my portfolio. Today, I'm going to show you what it really means to validate a portfolio of automated trading systems. In this video, we're going to see absolutely everything. The process from running the backtest to building the real equity of the portfolio, all the way to the 10,000 Monte Carlo simulations, which are essential for understanding one fundamental thing. What is the risk of my portfolio as a whole? Welcome everyone, I'm Andrea, your automated trader, and if you like what I do, leave a nice like on the video, subscribe to the channel, and turn on the notification bell so you won't miss the next videos I publish. So let's start from the beginning. The first thing I did was to tidy up my automated trading portfolio. Nothing spectacular, just small details, minor errors, little technical adjustments that didn't really change the portfolio. When you work with many trading systems, it's clear that over time, these small imperfections accumulate and then they need to be managed and fixed. So before redoing all the analysis and statistical calculations, I decided to take care of all these little mistakes. I cleaned everything up, checked the data, and verified each individual strategy. But I still didn't change the logic of the portfolio. I simply did what anyone should do before redoing a serious and thorough analysis. Starting from a solid foundation is essential because when you work with statistics, even the details are very important. Once the portfolio was fixed, I had to start everything over from scratch. I began by running backtests for each individual strategy, both on the period used for testing, so for optimization, as well as the test period itself. Next comes the out-of-sample period, so up to today. This is a step that many people skip because they focus mainly on profit, but in trading, you shouldn't just look for profit, you also need to seek the statistical consistency of what you're doing. If you redo all the tests with these small changes, the results remain similar. This means that your system is robust. If the results are completely different, it means you have a system that is quite fragile. In my case, everything remains similar to how it was before these changes, and that's exactly what I wanted to see. Because in any case, it means that the system doesn't depend on a single market period. It depends on the entire structure of the strategy. So the first thing to do is to import all the backtests into Quant Analyzer. Quant Analyzer is a free program that you can find by searching for it on Google. I have the free version, in fact, because for what I need to do, it's perfectly fine and I don't need to buy the license. So the first thing I need to do is import all my tests into the program. You do this by clicking on Load Report, and then I go to Select. I have them all. All the tests in a single folder. They must be in HTML format. So for example, now let's import one and I'll show you what you need to do. So we import our test, click OK, continue, and the test is imported. At this point, it's essential. When you have all the tests loaded here one by one, you go to the list of trades. So the list of trades that have been made by this strategy, and you export them to CSV using this button. So when I do this, it exports the CSV file with all the trades inside. So I do this for all the strategies I have in my portfolio. And this is essential in order to then work in Excel and create my portfolio's compounded equity. Why do I have to do all this? Because the program is not able to calculate the compounded equity, that is trade by trade. It simply adds up all the equities. This is a big problem, especially if you have one equity that earns little and another that earns a lot. Because in the end, if you just add them up, the result will always depend on that one. On the equity that earned the most, instead, by compounding them, you actually get the performance of your trading account. Day by day, trade by trade. And you also know what the real drawdown is, because by simply adding it up, you obviously get a drawdown that is indicative, but not real. It's not what you would have seen if you had used all the strategies together. So this work is essential if you want to have accurate data on how your portfolio works, both in terms of drawdown and profit. That's it. Thank you all. Or for anything else you want to calculate, it's necessary to go through this entire process. Here, this is the Excel file where I imported all the data. So as you can see here, the export that the CSV gives you is always formatted like the one you find in this file. Basically, it has all the strategies, the symbol, the opening time, the opening price, the date, a lot of information. The thing we need most is to know how much we earned on each trade in percentage terms. So the loss or gain in percentage, which is this column here. So by then using these losses, it's very simple, knowing what amount we're starting with in the account. I started with 10,000, which is the same value you need to enter in the test. So use the value you set in the back test and add up all the trades. So starting from 10,000, the first one lost 0.76%. So the compounded equity became 9,924. Then the next one lost again. So I went down to 9,872. And so on until you reach the end. In the end, you have a real equity curve of what would have happened trade after trade on your portfolio. Once I have the compounded equity, it's clear that I can calculate a lot of values to understand how I'm managing my portfolio. If I'm taking on too much risk, if I'm risking too little, if I'm earning enough. In short, I go and see what happens then. I calculated these data that you see here in this little table. The most important one is clearly the first, the drawdown, because I need to know how much drawdown I had. In my case, here I consider both the in-sample and out-of-sample periods. I started from 2020 to have a few years of historical data, and I had a maximum drawdown of about 35%. Then, as a first approximation, I calculated the standard deviation, as I had shown in the other videos and with the bands, of risk that I could reach, just as a first approximation. What is good, however, and unusual is that during the period after our optimization ended, so in these 14 months of out-of-sample, we had a relatively low drawdown. So there was a market that was favorable to what we were doing. As in the previous videos I made about the portfolio, it has remained almost unchanged. The ratio between the worst day and the best day, which you can see, is always there. A ratio of about 3 times. So the worst one, I lost 11%. The best one, I gained 35%. The same thing happened to me, even later in the out-of-sample. So I lost 8% on the worst day, and on the best day I gained 29%. This ratio of about 3 times is maintained. Risk and return also, well, here you have all the other values without going into too much detail. We can see, however, that there was a period of 51 days when the portfolio did not go up. So this gives you the idea that it's not a portfolio that earns a little bit every day, like many people show you in those perfectly drawn equity curves. This is a real portfolio. It has good periods, sideways periods, and also very negative periods, because here 50 days in drawdown means almost 3 months without earning anything. Of course, in the following months, it might recover and reach new highs, right? So that's how it is. It's a bit of a characteristic of this portfolio. The profit factor is always around 1.23, 1.22, 1.23, so it's stable at these levels. Now let's focus on something important, because the daily expectancy is good for the system, but that doesn't mean you make money every day. As I told you, this is an average because it takes the average. It averages out. So there will be days when you make money and days when you lose. So this is important because it's not a system that makes money every day, but it's a system that over the long term has a positive track record. So in the long run, I will end up in profit and make money, but not consistently. It's not a linear gain. At this point, however, we come to the most important part, because having a good backtest doesn't mean anything about the future of our system. The market can behave differently from what we've seen during these years of testing, and that's the fundamental thing. What is it? It's about putting the system under stress and trying to understand what happens under stress. What's important is to see what happens if the sequence of gains changes. And what do we do to achieve this? We perform a Monte Carlo analysis on our portfolio, taking it day by day. So I look at how much I gain or lose each day, and I shuffle the order of these days. So this is the file where I imported the data I needed. In the first column, I have the date with all the dates when my portfolio was active. So each strategy has been active since the second. From January 2020, in fact, I started at the beginning of 2020 up to today, and in the second column you have the daily percentage profit, so 0.02. This means that, for example, here I lost 2%. So what do I do then? I make 10,000 columns, so 10,000. Simulations where I randomly take these daily profit values. So I take them randomly, I shuffle them, let's say completely at random, and see what happens. So this is really the basis of this Monte Carlo analysis, which shuffles the data to see whether I would have gained or lost, or how the situation would have turned out if the sequences of my trades, of my trading days in this case, had been different. So maybe in my actual results, in my backtest, the maximum I had was 30 consecutive losing days. If I shuffle them, maybe it turns out I get 40 losing days in a row, so a worse scenario. Or maybe it turns out I only get 25 because I've improved the situation a bit by doing this over a large number of simulations, since 10,000 is quite a big number. I get many different scenarios and I go and collect data, as I'll show you later, to understand where my system is heading and where it could statistically go in the future. Clearly, I can't predict the future, but I can use statistics to try to make a forecast about how things might go. All of this is statistical, of course. Obviously, this is a statistical forecast, not a prediction of the future, because no one knows what the future will be. But this helps me understand whether I have values that are acceptable or not. Once I've done all these simulations, what do I do next? I calculate the maximum drawdown, because the value that interests me in all these calculations is understanding what the maximum drawdown I could reach is. So I calculate the drawdown for each column, meaning for each simulation. Here at the bottom, I have a cell where I've done exactly this. To do this, I created a macro in Excel, so a small program that calculates the maximum drawdown for me. If you're interested in knowing how to do things like this, let me know in the comments and I'll make a video to show you how I calculated the maximum drawdown with this macro in Visual Basic. Now that I have the maximum drawdown for each column, I have 10,000 data points, so I take this data and analyze it. So I created another file for myself because the one with all the simulations was very large. It was about 300 megabytes of data. And in Excel, it took a long time to process everything, so I only imported the drawdown data. So the last row that I showed you, here I have the 10,000 drawdown values from each simulation. And so I went ahead and calculated all these data points you see down here. At this point, someone might say, yes, but why did you do that many? 10,000? Who told you that you had to do 10,000? Maybe that's too many, maybe it's too few. You could have done 100,000 or you could have done 1,000. So how did I determine that 10,000 was a reasonable number? I calculated this Monte Carlo statistical error. And my error is 0.05%, 0.06% if we round it up. So that means the numbers I'm coming up with can have an error of 0.06, which is basically nothing. So if I get a value of 10%, with the error it could be 10.06% instead of 10%. It's practically irrelevant. I don't bother with these tiny percentages, I just take the round number. If I get a drawdown of 32%, it's 32%. I don't even bother calculating the decimals. So this tells me that the Monte Carlo I'm running is quite accurate. With these 10,000 simulations, it probably would have been enough to do even fewer. But just to be safe, I did at least 10,000. This isn't an opinion, this is pure mathematical statistics. So let's see what we've obtained from all these massive calculations. So thank you. We've gotten the first piece of information, which is the average. That is the average drawdown of the system. With these 10,000 possible scenarios, we have a 32% value, which is similar to what we obtained in our backtests. The best case, on the other hand, was 18%, so a luckier sequence of trading days led to 18%. The worst case, however, which is also a very important value, so the worst case that we simulated, we had a drawdown of 60%. Now, however, that's not enough. We need to understand how our 10,000 values are distributed, whether there's only one at 60% or if there's a large group. Close to 60% and only a few perhaps near 18%, which is the best case. We need to carry out an analysis of our population of numbers. So I calculated these thresholds. What do they represent? Here I have the probability of exceeding a 35% drawdown, 40%, 45%, and so on. As you can see, the higher the numbers go, so the bigger the drawdowns, the smaller the probability of reaching them becomes. So it's very likely that I'll reach a 35% drawdown, and in fact, I've seen it. I've reached it even in backtests. It will be very unlikely that I'll reach 60% because I have a probability of 0.03%, so it's very low. But it could happen. So I've seen that the behavior of my system in the test is consistent with what came out of my statistics. In short, it's not a stroke of luck, it's pure statistics. This calculation completely changes the way I look at trading because now I know exactly what to expect in the future. If I see a 40% drawdown, I'll know that I'm still within my statistics. It's a low probability, but it could happen. It won't be a surprise nor a problem. It will be something I had already anticipated from the start. This is the real advantage you gain after doing an analysis like this. Not predicting the future, but understanding what is normal for the model and what is not. From now on, then, comes the hardest part of all. The current job is no longer to improve the system, create new experts, or find magic settings. The real job is to not touch anything anymore, because the system has already been validated. It had its backtest period, it had the out-of-sample period, I did the Monte Carlo analysis, I got my data, so the engineering work is done. Now the truly difficult part begins, which is simply executing. I spent years creating this portfolio, strategy after strategy, thousands of hours of backtesting, simulation after simulation, Monte Carlo analysis. And today I can say something simple. My portfolio is truly finished. It's complete. Now all that's left is to see what will happen in the coming months in the real market. If you liked this video and found it useful, send it to a friend on WhatsApp, because that's how important information gets around. See you in the next video.